What if I told you that you could stop overcomplicating investing forever? That building real wealth doesn't require a finance degree, hundreds of hours of research, or guessing which stock might explode next week. I know it sounds too simple, almost like a trick, but the truth is, it's not, because sometimes the smartest way to win the game is to stop playing it the hard way. While most people are jumping from one investment idea to another, trying to predict the market, there's a quiet group of investors doing something completely different. They're not glued to stock charts, and they're not panicking every time the news mentions inflation or a market crash. They're calmly building wealth year after year using just 4 simple ETFs. That's it. 4. Not 40, not 400. Just 4. And today I'm going to show you exactly how that works. Now, before we jump in, let's get one thing straight. The investing world is noisy on purpose. Every day you hear people shouting about the next big stock, the next hidden gem, the next must-buy now or regret forever opportunity. Financial news channels, social media influencers, and Wall Street itself all push this idea that successful investing has to be complicated. Because let's be honest, simplicity doesn't make them money. Complexity does. It sells products, courses, and headlines. But it doesn't make you rich. In fact, it often does the opposite. The truth I discovered, and the truth the smartest investors quietly know, is that you don't need to chase endless opportunities to build wealth. You just need the right foundation. And that foundation can be built with 4 carefully chosen ETFs that balance growth, income, innovation, and stability. Together they form what I like to call a complete financial ecosystem, one that grows quietly, works efficiently, and takes only minutes a month to manage. So let's start with the first pillar, the one that gives your entire portfolio strength and direction, the Vanguard S&P 500 ETF, ticker symbol VOO. Now, you've probably heard of the S&P 500 before. It's often called the heart of the American stock market. But what makes VOO special isn't just that it tracks those 500 big companies. It's what it represents. When you buy VOO, you're not just buying one investment. You're buying a little piece of hundreds of the strongest businesses in the world. You're becoming a co-owner of Apple, Microsoft, Amazon, and hundreds more. Imagine owning a slice of every major company that makes the modern world run. From the phone in your hand to the car you drive, the medicines you take, and the stores you shop in. That's what VOO gives you. And here's the magic. You get all of that for almost no cost. VOO charges just 0.03% a year in fees. That's like paying $3 per year for every $10,000 invested. Think about that. For the cost of a cup of coffee, you get ownership in companies worth trillions. That's why professional investors, retirement funds, and even billionaires quietly hold VOO. It's not flashy, but it's powerful. Over the past decade, it has doubled investors' money, while keeping costs so low that very few funds can compete. And unlike trying to pick individual winners, with VOO, you don't have to worry about which stock will rise or fall. You already own them all. If some companies fall, others rise. The strong lift the weak, and the machine keeps moving forward. Now let's add our second ETF, the one that turns your portfolio into a true wealth-building engine that doesn't just grow, but also pays you along the way. It's called the Schwab US Dividend Equity ETF, ticker symbol SCHD. Here's where the story gets exciting, because SCHD doesn't just focus on growth, it focuses on income, real cash paid to you just for owning strong companies. But unlike many funds that chase high yields from risky companies, SCHD focuses on something different: consistency. It holds businesses that have been paying and increasing their dividends year after year, even through tough times. Think Coca-Cola, Pepsi, Texas Instruments, Verizon, and Home Depot. These are companies that don't just survive, they thrive, even when the economy struggles. What makes SCHD powerful is how it turns patience into profit. Right now, it pays about a 3.5% dividend yield, which means if you invest $10,000, you earn about $350 a year. And that number keeps growing because these companies raise their dividends regularly. Over the past few years, SCHD's dividends have grown around 12% annually. That means your income doesn't just keep up with inflation, it beats it. And the best part, those payments can be reinvested, buying more shares, which means next time you get paid, you earn even more. That's how compounding works. It's like planting a tree that grows fruit, and every piece of fruit grows another small tree that keeps producing forever. SCHD turns your money into a living, breathing income machine. Now let's move on to our third ETF, the one that captures the world's most explosive innovations. This is the growth engine, the one that keeps your portfolio connected to the future. It's called the Invesco Nasdaq 100 ETF, ticker symbol QQQM. If VOO represents America's solid foundation and SCHD represents income and discipline, then QQQM represents the frontier, the future being built right now. When you own QQQM, you're investing in companies that are changing how the world works. Leaders in artificial intelligence, cloud computing, semiconductors, digital media, and more. Think of companies like Apple, Microsoft, Nvidia, Amazon, Tesla, and Meta. These aren't just stocks, they're forces of innovation driving the entire global economy. Now here's something interesting. Most people know about QQQ, the bigger version of this ETF, but QQQM is the smarter twin. Same holdings, lower cost. It charges just 0.15% a year, which means more of your profits stay in your pocket. Over the past 5 years, QQQM has grown by over 70%, thanks to the tech boom and the unstoppable march of innovation. And yes, tech can be volatile. It goes up fast and sometimes down fast, but that's exactly why it's only one part of the system. Because when the tech world stumbles, our other ETFs like SCHD and VOO step in to balance things out. And when tech takes off again, QQQM ensures you never miss that rocket ride upward. It's like having one foot on solid ground and the other on the fastest train heading toward the future. Now let's talk about our fourth and final ETF, the Vanguard Value ETF, ticker symbol VTV. This one is often overlooked because it's not about excitement, it's about balance. You can think of VTV as the calm, steady hand that keeps everything under control when markets get turbulent. While QQQM races ahead chasing innovation, VTV quietly invests in companies that are a bit slower but incredibly reliable. These are businesses that produce steady profits, pay solid dividends, and trade at fair prices. We're talking about companies like JP Morgan, Procter & Gamble, Exxon, United Health, and Johnson & Johnson. Companies that don't depend on hype to grow, they're the backbone of the economy. And when the market gets scared, investors often run to these safe havens. That's what makes VTV so valuable. It gives your portfolio protection during tough times, without sacrificing long-term growth. VTV has delivered solid returns, around 14% in the last year, and has raised its dividends for 14 consecutive years. But more than that, it provides emotional stability for you, the investor. Because when markets crash, and they always do eventually, it's this kind of ETF that helps you sleep at night. And when things rebound, your other funds like VOO and QQQM take the lead again. It's a beautiful balance of offense and defense, growth and safety, energy and calm. Each ETF complements the others perfectly. So now that we've talked about all four, let's see how they work together. Imagine them like a team. VOO is your foundation, strong, broad and reliable. SCHD is your paycheck, paying you every quarter while you wait. QQQM is your dreamer, the one chasing tomorrow's biggest breakthroughs. And VTV is your protector, the one who keeps everyone grounded when things get wild. Together they form an all-weather portfolio that doesn't just survive different markets but thrives through them. Whether inflation is high, tech is booming, or the market is falling, one of these four is always working for you. Now you might ask, how should you balance them? Well, that depends on who you are and where you are in life. If you're young, say in your 20s or 30s, you might go heavier on VOO and QQQM, maybe 40% VOO, 35% QQQM, 15% SCHD, and 10% VTV. That gives you strong growth for the long term. If you are in your 40s or 50s, approaching retirement, you might choose something more balanced like 35% VOO, 20% QQQM, 25% SCHD, and 20% VTV. That keeps you growing but also adds more income and safety. And if you are already retired or close to it, You might flip it around. More SCHD and VTV for income and protection, and a smaller portion in QQQM for long-term growth. The point isn't to copy someone else's mix exactly. It's to understand what each piece does and then make it fit your life. And maintaining this portfolio? Easier than you think. Once or twice a year, check if any ETF has grown too large or too small compared to your target. If one of them is way above or below its weight, just rebalance by buying or selling a bit. That's it. 15 minutes a year. The rest of the time, do nothing. Don't stress about headlines. Don't panic when the market dips. Remember, this system was built to handle that. When tech falls, value and dividends rise. When inflation hits, SCHD and VTV hold firm. When growth returns, VOO and QQQM soar. It's all about balance. You don't need to outsmart the market. You just need to stop fighting it. And here's the real secret. Investing isn't about predicting the future. It's about being prepared for it. You can't know what the market will do next month, but you can build a portfolio that thrives no matter what happens. These 4 ETFs do exactly that. They give you diversification across industries, stability through cycles, growth for the long term, and income along the way. They give you freedom. Freedom from stress, from noise, from overthinking. Once you set this up, you can finally focus on what really matters in life. Your time, your family, your goals. The money takes care of itself. So let me leave you with this thought. Wealth isn't built by chasing the next big thing. It's built by staying consistent with a strategy that works. These 4 ETFs, VOO, SCHD, QQQM, and VTV, are all you truly need to build a solid, growing, unstoppable portfolio. You don't need to check your phone every day. You don't need to guess what the Federal Reserve will do next. You just need to stay the course. Because in the end, the investors who win aren't the ones who make the most trades. They're the ones who make the fewest mistakes. And the simplest plan is often the one that lasts the longest. If this message resonated with you, take a moment to think about your financial future. Imagine a life where your money works quietly in the background, growing, paying you, protecting you, without stress. That's what these 4 ETFs can do. So stop overthinking, stop second guessing, build your foundation, set your plan, and let time do the heavy lifting. The sooner you start, the sooner your future begins. Smash that subscribe button, leave a comment, and see you soon. Just a reminder, I'm not a financial advisor. This video is for educational purposes only, and any results depend on your own decisions and actions.